Alright, welcome back to the fifth part of chapter 20. Right, in the previous part we were looking at evaluating the change in credit policy. Okay, so this is actually a continuation of that. This is the analysis given in your slide, but I have made a slight change here. Okay, so let's look through this. I think this method that that's given in the slide is more difficult compared to the table that I gave you in that I showed you in the previous part, the previous clip. Right, but it comes to the same answer. So as you can see here, the incremental cash inflow, this is monthly, will be $100 minus 40. This is what you collect, the price minus the variable cost, multiplied by 1,050 minus 1,000. Therefore, this is $3,000 monthly. And the present value of this monthly incremental cash flow is 3,000 divided by 1.5% or 0.015. You get $200,000. Okay, so the cost of switching, this is the cost incurred now. This is $40 multiplied by 1050. This is the new sale cost. And this 100 minus 40 multiplied by 1000, this is the foregone wholesale collection. So this is $102,000. So the net present value is this minus that, which is 98,000. So yes, the answer is the same whether you use this method. But this method, it does not give you the full formula. It assumes that the price and the variable cost remains the same, okay, with the change in the credit policy, but that need not be the case. So please take note of the formula that I gave you in the previous slide and also in the previous part, previous clip. Okay, so this is not very useful. It's not a general method. Okay, the general method is the method that I showed you in the previous clip. So please use that. Let's move on now. This is the fourth part, fourth key concept in this chapter. Okay, as indicated here, fourth. So here we're going to look at the total cost of granting credit. There are two types of costs, in credit, just like in other, short-term assets. We have seen working with working capital. We have two types of costs. One is called carrying cost. The other is shortage cost. So carrying cost is always positive, positively related with the amount of credit given, meaning the amount of receivables the company holds. So the higher the amount of receivables, higher the carrying costs. That is why it's positive relationship. Now, shortage cost is negative relationship. The more you hold receivables, the lower your shortage cost. So what is carrying cost here? This is required return on receivables. So if you have more receivables, then you have more required return. Okay, so that will be a cost. So you forego this return. And there's also losses from bad debts. You hold more receivables, there will be a larger portion of your receivables that will not be collected. So many of your customers, or a portion of your customers, will not pay. So this will result in bad debts. So this will be a loss. This is also part of carrying cost. Then you also have the cost of managing credit and collection. You need a department to manage the credit and also to monitor collections. So all this administrative costs will come under carrying costs. Now, shortage costs, on the other hand, they relate differently. They behave differently. The carrying cost is positively related. This shortage cost is negatively related with receivables. So the shortage cost arises from lost sales due to a very restrictive credit policy. So if you don't give enough credit, okay, so you lose sales. And this loss of sales is more difficult to measure. It's not so obvious, this shortage cost. Okay, because this is an opportunity cost, or opportunity loss. Okay, so it's not immediately visible, or measurable, for the company. But definitely, okay, we know that if you have a more strict credit policy, then you will lose sales. Yeah. So if you have a more inviting, yeah, or more positive, yeah, credit policy, then you will increase sales. Yeah. So if you have very restrictive credit policy, that means you don't give a lot of credit, then your receivables will be very low. Yeah. So your carrying cost will be low, but your shortage cost will be high, yeah, because you lose some sales, yeah, because you don't provide credit, or you're not very generous in providing credit, then there will be some loss of sales. Yeah. So that is to do with shortage cost. Now the total cost of credit, yeah, you have to include both carrying cost and shortage cost. Yeah. This is the sum of carrying as well as shortage cost. So we need to try and be close to the optimal credit policy. Yeah? We try and strike a balance between the two, where the total cost curve is minimized. Yeah? The total cost reacts in this way. Yeah? This diagram tells you this is the opportunity cost or shortage cost. Yeah? We call this shortage cost or opportunity cost. And this is the carrying cost. Yeah? More receivables or more credit. Okay, this axis gives you the amount of credit given, yeah, or the amount of receivables held by the company, and this will be the cost. Yeah. Now this yellow curve is the sum of this green curve and the blue line. Yeah. So this is the sum. Yeah. So this is the total cost curve. Yeah. Total cost of these two. Yeah. So you find that if your credit is too low, okay, your shortage cost is very high, yeah, even though your carrying cost is low. But if your credit is too high, okay, you give too much credit, then your carrying cost will be too high and your opportunity cost will be low, yeah, but your total cost will still be high. But at this point, okay, this total cost is minimized. Okay, at this point the carrying cost and the opportunity cost should be the same. Yeah, they should intersect, and therefore the cost should be the same. Yeah, that's the idea behind the optimal, yeah, credit. So we should try to be here, not give too much and not give too little credit. Is that okay? But this is conceptual. Yeah. If you want to quantify this is more difficult. In reality, if you want to quantify, because this opportunity cost is very difficult to measure. Okay, we don't have a very definitive measure of opportunity cost, yeah, for receivables or credit. Okay, right. Now we come to the fifth key concept in credit management. Yeah, we call this credit analysis. Now this credit analysis is the process of deciding which customers should receive credit. Okay, so who to give credit to and who not to give credit to, yeah, will be based on our credit analysis. Yeah, for this we need to gather information. Yeah, this information can be gathered from financial statements. Yeah, financial statements of whom? Of the customers. Yeah, the customer firm's financial statements, credit reports about the customer, bank statements or bank references, yeah, about the customer, and also the payment history with the firm. Yeah, for example, if the customer has bought from the company previously, okay, how much have they bought, have they been able to pay immediately with cash and so on, or if you have sold to them on credit before. Yeah, these are all payment history. Yeah, so we can use that to decide whether the customer should be given credit or not. Okay, then there are frameworks, yeah, to determine the credit worthiness, yeah, of a customer. Yeah, we call this the 5 C's of credit. Okay, this is a very famous, yeah, model of credit analysis. We'll look at these 5 C's a bit later. Yeah, but this is one method of determining the credit worthiness. Yeah, then you also have credit scoring. Yeah, this credit scoring will be, it will have some criteria, yeah, some credit worthiness criteria, and then you score each customer, yeah, based on each criteria, and then you total up the score and see if the score is high, then you can give credit to the customer. If the score is very low, then you should not give credit. Yeah, you can sell on cash basis but not on credit basis to those customers. Yeah, so that's called credit scoring. Yeah, we look at the 5 C's. There are not many examples in the textbook about credit scoring. Yeah? They explain about the concept of credit scoring. Yeah? So you can read the textbook for more information about this. Yeah. Alright, now when should credit be granted to a customer? This is a one-time sale. Yeah? So here it means that a customer comes to you, applies for credit. Yeah? That means they want to buy on credit basis. Yeah? They ask for a credit term. They buy now and they pay later. So how do you decide whether to give or not to give credit to those customers? Yeah? So this is one model. We call this the net present value analysis. Again, this is NPV, yeah? Net present value, just like we did earlier in the previous clip. Okay, here the NPV formula we use is equal to negative V. This is the variable cost. Yeah? V, capital V is the variable cost per unit. P is the price per unit. Okay, then this is 1 minus pi. Pi here is the probability that the customer will default or will not pay. Okay, this is the probability that the customer will not pay. Yeah, divided by 1 plus R. Yeah, now so we know R is the required return on receivables. Yeah, this is the discount rate. Yeah, so why is the formula this way? Yeah, so if we will try and explain that, but the decision here is if the net present value is positive, this NPV is positive, then credit should be granted. If this is negative, then you should not grant credit. Yeah, that's the principle. Yeah, now let's look at the timeline now. Yeah, this is end of one credit period. Yeah, so the customer comes now, they want to buy, and they pay at the end of the credit period, one credit period. Yeah, it can be 30 days, it can be whatever time. Yeah, you just consider that as one credit period. Okay, now at this point, when you sell to the customer on credit, you will incur the cost of sale. Yeah, the cost of each product. Yeah, we assume that this outflow occurs now. Yeah, of course, in reality, this may occur earlier. Yeah, but we are comparing this, yeah, with cash sale. Yeah, and therefore in cash sale you incur this now and you collect now. Yeah, but in this case you assume that you incur this now but you collect later. Yeah, so this variable cost per unit will be a cash outflow. For every product that you sell on credit, you incur this variable cost. Yeah, we assume it occurs at time 0. It's an assumption. Yeah, in reality this will be incurred earlier. Yeah, but here we assume that it occurs at time 0. Now these are the possible cash flows. Yeah, there are two possibilities. Yeah, remember the concept of possibility that we have seen in chapter 13. Okay, risk and return. Yeah, we looked at this when we compute the expected return. Okay, here we have expected cash flow. So we use the same concept here, yeah, similar concept. So there are two possible cash flows. One is P. This is a cash inflow. Yeah, when the customer pays, okay, they will pay the price per unit at the end of the credit term. Yeah, there are two possibilities. Okay, they pay or they don't pay. This is 0. Yeah, that means they don't pay anything. Yeah, they don't pay anything, or they pay nothing. Yeah, all right. This is when they make full payment. Yeah, this is when they make the payment. Yeah, so the company will receive P. This is the cash outflow. This will be the cash inflow. There are two possibilities. Yeah, there will be a cash inflow or there is no cash inflow. Yeah, right. What are the probabilities? Then we look at the probability. Yeah, the probability of the customer defaulting, that means they make 0 payment, is pi. Yeah, remember pi, probability that the customer will not pay. This is pi. Yeah, the symbol pi refers to the probability of default of the customer. If they default, then they don't pay anything. Yeah, this is the opposite. Yeah, meaning 1 minus the probability of default will be the probability that the customer will pay. So 1 minus pi. Yeah, remember this is 1 minus pi. Yeah, here. Now, so these are the possible cash flows. This is the probability. So what is the expected cash flow? The expected cash flow is this multiplied by this plus this multiplied by this. Yeah, but this multiplied by this is 0. Yeah, anything multiplied by 0 will be 0, right? Therefore it is just P multiplied by 1 minus pi. This is the expected cash flow at the end of one credit period. Now this is what you expect to gain. Okay, this is the expected cash flow, positive. Yeah, cash inflow. This is the current cash outflow. So is this worth more than this? Yeah, that is what we want to do. We cannot add a